Welcome back, navigators. In today's video, we will discuss practical strategies to safeguard your money against the diminishing purchasing power caused by inflation. Together with the tax on capital gains and dividends, inflation forms what Warren Buffett calls the investor's misery index. So did you ever ask yourselves why the same amount of money seems to buy less over time? Or why that coffee you enjoy every morning seems to cost a bit more each year, and even more starting 2022? We've all felt it, the subtle, almost imperceptible increase in the cost of living, and not only us, but older generations as well. But what's behind this phenomenon? It's called inflation, a general rise in prices over time, which in turn reduces the purchasing power of your money. Inflation is everywhere, affecting everyone, from the individual saving for a rainy day to an investor looking to grow his wealth. It's a universal economic reality, ask Argentinians, Turks, Venezuelans, or Zimbabweans, that chips away at your hard-earned savings and investments, and it's often overlooked until it's too late. But don't be disheartened. Understanding is the first step towards tackling any problem, and that's what we're here for, to demystify the concept of inflation and arm you with the knowledge to navigate its tricky waters. Inflation, dear navigators, is the silent thief that erodes your hard-earned savings and investments. Let's take a look at a real-life case study of John, a diligent saver who kept his money in a regular savings account for 10 years. John, a hard-working man in his mid-30s, took a very traditional route to saving money. Every month, like clockwork, he deposited a portion of his earnings into a regular savings account. Over the span of 10 years, he tucked away a substantial amount, intending to use it for his family home acquisition. But an unseen force that emerged after the COVID-19 pandemics was quietly chipping away at John's hard-earned nest egg, that force being inflation. Inflation, in its most basic sense, is the rise in the cost of goods and services over time, effectively decreasing the purchasing power of money. It is the central bank that created a huge quantity of money to supply the economy, money that started to chase goods and services and other opportunities as soon as the economies reopened. Faced with such amounts of money, suppliers, providers, sellers immediately rose prices, fees, and tariffs. While John was saving, the world around him was getting more expensive. A loaf of bread that cost $1 when he started saving was costing $1.40 10 years later. The same thing was happening to almost everything else. John's bank, like most, offered an interest rate on savings. However, the rate was a mere 1% per annum. It seemed like a good deal at the time. After all, who wouldn't want to earn money on their savings? But here's where the problem arose. The rate of inflation during this decade was a lot higher than that, in excess of 2.5% per year. This means that while John's savings were growing by 1%, the cost of living was increasing by more than 2.5%. The result? John's savings were losing their purchasing power. Even though his savings account balance was technically growing each year, the real value of his money was diminishing. His dollar could buy less and less as time went on. In effect, John's diligent savings were being eroded by the tide of inflation. This is a common pitfall for many savers. They think their money is safe in a savings account, but fail to consider the creeping impact of inflation. It's like trying to run up a down escalator. You might be moving, but you're not getting anywhere. Now, meet Sarah, an astute investor who diversified her portfolio to beat inflation. Sarah, like many of us, was aware of the creeping impact of inflation, and she didn't want her hard-earned savings to erode over time. So she chose to diversify her investments, putting her money into stocks, ETFs, bonds, and real estate. Let's look closer at how her investments fared over a 10-year period. Sarah's stock investments, for instance, offered returns that not only kept pace with inflation, but exceeded it. While the inflation rate hovered around 2 to 3%, her stocks, on average, provided an annual return of at least 7%. This is primarily because companies can adjust their prices to account for inflation by transferring any increase to the consumers. And these adjustments are often reflected in their stock prices. Next, let's consider her bonds. While bonds are generally considered less risky than stocks, they can be more vulnerable to inflation. However, Sarah wisely chose to invest in inflation-indexed bonds. These are special types of bonds whose interest payments and principal are adjusted for inflation. So even when inflation rose, Sarah's bonds didn't lose their purchasing power. Still, corporate bonds also offer higher yields, but the risk of default of companies is also higher. Finally, let's turn to Sarah's real estate investments. Real estate has long been considered a reliable hedge against inflation. This is because property values and the rents that properties can command tend to increase with inflation. Over the 10-year period, Sarah's real estate investments appreciated in value and generated a steady stream of rental income, both of which outpaced inflation. Sarah's approach highlights the importance of diversification and investing in assets that can potentially offer returns higher than the inflation rate. She didn't put all her eggs in one basket. Instead, she spread her investments across different asset classes, each with its own way of weathering inflation. Sarah's story shows us that wise investing can help us stay ahead of inflation. By following her example, we too can protect our wealth and ensure its growth even in an inflationary environment. So how can we shield our finances from the relentless march of inflation? Firstly, diversify your investments. Spreading your investments across a variety of asset classes can help to balance risk and reward. You can consider investing in stocks, bonds, real estate, and even commodities. While some of these investments may perform poorly during inflation, others may thrive. This balance can help protect your overall portfolio from severe losses. Do some research on how the return on each of these classes performed against inflation. There is a lot of data available. Secondly, consider inflation-protected securities or TIPS. These are types of treasury securities designed to help investors protect against inflation. They're unique because their principal value rises with inflation as measured by the Consumer Price Index. When inflation rises, so does the value of your TIPS, ensuring that your investment keeps pace with the cost of living. However, not all countries have these instruments available. In these cases, normal government bonds could be purchased. Lastly, building an emergency fund is a must. This is a stash of money set aside to cover unexpected life events. It's like wearing a seatbelt while driving. You hope you never need it, but it's invaluable if you do. The idea here is, as we've seen in other videos, to have at least about 3 to 6 months worth of living expenses saved up. Having this safety net can provide a buffer against inflation, allowing you to avoid dipping into your investments during tough times. Now remember, these strategies are not one-size-fits-all solutions. What works best for you depends on your individual financial situation and risk tolerance. It's always a good idea to consult with a financial advisor or do your own research before making any major financial decisions. By taking these steps, you can turn the tide in your favor and protect your hard-earned money from inflation. Inflation may seem like a formidable enemy, but it's not insurmountable. It's a challenge we face in the financial landscape, a hurdle that demands our attention, but certainly not a death sentence. We've seen the effects of inflation, how it silently eats away at your savings and the way it influences your investments. But remember, with the right strategies, you can combat these effects. We've explored practical tips to protect your savings and investments, such as diversifying your portfolio, investing in assets that tend to appreciate over time, and keeping an eye on interest rates. Inflation is like a game of chess, a constant dance of moves and counter-moves. It's not about eliminating the opponent, but understanding its moves and strategizing accordingly. Armed with knowledge and the right strategies, you can outsmart inflation and secure your financial future. It's a challenge, but one that you are fully equipped to meet head-on. That's all for today. Until next time, take good care of your finances, navigators, and don't forget to subscribe and share if you found any value.